Did you know that some of the wealthiest people in the world, those worth billions, often pay a lower tax rate than most middle-class workers? It's a paradox that feels unfair, yet it's all perfectly legal. Warren Buffett, one of the richest men alive, has openly admitted that he pays a lower tax rate than his secretary. How is that possible? The answer lies in the complex strategies the rich use to grow and protect their wealth. Strategies that take full advantage of a global economic system designed to reward investment over labor. These aren't loopholes in the sense of bending the law. They're embedded in how wealth is taxed. From the lower tax rates on capital gains to utilizing offshore tax havens, the methods are both ingenious and eye-opening. But there's more to this story. This isn't just about individual billionaires or corporations. It's about how these practices ripple through the global economy. When trillions of dollars are funneled through tax havens or shielded from taxation, what does it mean for public services, infrastructure, and the rest of us? In this video, we'll break down how these systems work, who benefits the most, and why these strategies matter to you. Stick with us to uncover the truth behind the numbers, because the next part will reveal a strategy billionaires use that will leave you questioning everything you thought you knew about taxes. And don't forget to like, share, and subscribe to Economy Explorer. You won't want to miss a single detail. Key strategy: capital gains tax. When most of us think of taxes, we think of income tax, the money taken out of our paychecks each month. But for the wealthy, the real story lies in capital gains tax. Let's say you work a full-time job and earn $100,000 a year. Depending on where you fall on the tax bracket, you might pay as much as 37% in income taxes. Now, imagine another person who also earns $100,000, but not from a job. Instead, they've made it by selling stocks they held for a few years. Their tax rate? Just 20%. That's nearly half the rate you'd pay for working hard every day. Why such a difference? The reason is simple. Our tax system favors investment over labor. Capital gains are profits earned from the sale of assets like stocks, real estate, or businesses. To encourage long-term investing, governments apply lower tax rates to these profits. On the surface, this makes sense. Investment fuels economic growth, creates jobs, and stimulates innovation. But here's the catch. When most of a billionaire's wealth comes from these types of investments, they end up paying a far smaller percentage of their income in taxes compared to an average worker. Think about this. Warren Buffett, one of the greatest investors of all time, earns the majority of his wealth from Berkshire Hathaway stocks. He doesn't pay himself a huge salary. He doesn't need to. By holding on to these stocks, Buffett minimizes his tax obligations. This is where the gap widens. While you pay taxes on every paycheck, the wealthy can decide when or if they want to sell their assets and trigger taxes. Until then, their wealth grows untaxed. That's like planting a money tree and not paying a dime until you decide to pluck the fruit. And it doesn't stop there. The benefits of capital gains tax don't just apply to stocks. Real estate works the same way. A billionaire might buy an apartment complex, hold on to it for years while it appreciates in value, and sell it at a profit. As long as it's held long enough, that profit gets taxed at the lower capital gains rate. Meanwhile, you might be paying a mortgage, property taxes, and maintenance fees, costs that don't have the same advantages under the tax system. This difference creates a striking disparity in how wealth is taxed and accumulated. Here's a question for you. How would your financial life change if most of your income was taxed at a lower rate? Would you save more? Invest differently? Think about that as we explore an even more mind-blowing strategy. Next, how the wealthy avoid taxes without selling their assets at all. Global perspective, tax havens, and buy, borrow, die. Picture this. A billionaire's private jet touches down on a tiny island in the Caribbean. There's no sprawling metropolis, no towering skyscrapers, just a few government offices and pristine beaches. Yet, this small country houses billions of dollars in wealth. Welcome to the world of tax havens, where the world's richest individuals and corporations quietly store their money, shielded from higher taxes in their home countries. The scale of this practice is staggering. Over $7.6 trillion of global wealth is hidden in these havens, money that could otherwise fund education, healthcare, and infrastructure. How does it work? Tax havens like the Cayman Islands, Bermuda, and Switzerland offer incredibly low or even zero tax rates on income and profits. Wealthy individuals and corporations park their assets there, often through shell companies, trusts, or offshore accounts. For example, a multinational corporation might report its profits in a tax haven instead of where the actual economic activity took place. It's entirely legal, but undeniably controversial. After all, if these profits aren't taxed, who makes up the difference? That's right, ordinary workers and taxpayers. But tax havens are only part of the story. Billionaires often pair this strategy with a technique known as buy, borrow, die. Let's break it down. First, they buy assets, stocks, real estate, or even art. As these assets increase in value over time, their net worth grows. Next comes the ingenious part. They borrow against those assets instead of selling them. Why? Borrowing isn't considered income, so it's not taxed. This gives them access to millions or even billions in cash without ever triggering a taxable event. Now here's where it gets even more strategic. Die. When these wealthy individuals pass away, the assets are inherited by their heirs. Thanks to a loophole called the stepped-up basis, the heirs are only taxed on the gains made after inheritance, not the original profits. This effectively erases decades of untaxed wealth growth. Think about that. While you're paying taxes on every paycheck and every sale, billionaires are using these tools to legally avoid them. It raises an interesting question. If the system allows it, can we really blame them? In the next section, we'll explore potential solutions to these economic disparities and what they could mean for global wealth distribution. Solutions and impacts. In 2024, the global economy faces a growing challenge. How do we create a fairer tax system without stifling investment and innovation? It's not a new debate. Decades ago, when President Franklin D. Roosevelt introduced higher taxes on the wealthy during the Great Depression, critics warned it would crush the economy. Instead, the U.S. emerged stronger, proving that bold reform is possible. But what could those reforms look like today? One solution gaining traction is the idea of a wealth tax. Unlike income or capital gains taxes, a wealth tax would target the net worth of an individual, including stocks, real estate, and other assets, whether or not they're sold. Proponents argue that even a small annual percentage, like 2% on fortunes over $50 million, could generate hundreds of billions in revenue globally. Imagine that money going toward infrastructure projects, climate initiatives, or reducing national debts. However, opponents warn of potential unintended consequences, such as wealthy individuals moving their assets to other countries or undervaluing their holdings to minimize taxes. Could the global economy adapt to enforce such a policy? Another approach is closing loopholes in capital gains taxation, specifically the stepped-up basis. Currently, this allows heirs to avoid taxes on decades of unrealized gains. Reforming this rule would ensure that wealth is taxed once it transfers to the next generation. A more aggressive option would be taxing unrealized gains annually, a controversial but potentially transformative policy. For example, imagine someone like Elon Musk being taxed on the annual growth of Tesla's stock value, even if he doesn't sell a single share. Critics argue this could discourage long-term investing, but supporters see it as a way to address vast economic inequality. On the corporate front, international tax agreements could reduce the use of tax havens. The OECD's Base Erosion and Profit Shifting (BEPS) project has already made strides, introducing a global minimum corporate tax rate of 15%. If fully implemented, this could stop multinational companies from shifting profits to low-tax jurisdictions, ensuring they contribute their fair share in countries where they operate. But enforcement remains a challenge, with countries like Ireland and Luxembourg reluctant to give up their competitive edge as low-tax hubs. Then there's the idea of simplifying tax codes altogether. Today's tax laws are so complex that they're a playground for accountants and lawyers. Simplifying the system, eliminating deductions, credits, and loopholes, could level the playing field. The challenge? Convincing governments to give up tools they use to incentivize certain behaviors, like homeownership or green energy adoption. As you consider these solutions, ask yourself, what trade-offs are you willing to accept for a more equitable system? Should economic growth come at the cost of fairness, or can we find a balance? Next, we'll explore the lasting impacts of these policies and what they mean for the future of wealth distribution. Rethinking taxes, a fairer future for the global economy. Let's pause for a moment and reflect. The world's richest individuals aren't villains. They're playing by the rules of a system that was built to reward wealth, not work. But this system has consequences. Every untaxed dollar in an offshore account or unrealized gain on a billionaire's balance sheet is a dollar that isn't funding schools, hospitals, or the infrastructure we all rely on. It's not just an economic issue, it's a question of fairness. Should the richest among us contribute more, or is the system working as intended? Consider this. In the 1950s, the U.S. experienced one of its greatest periods of economic growth, and the wealthiest paid tax rates as high as 91%. Compare that to today's tax landscape, where creative strategies like buy, borrow, die, or capital gains loopholes allow billionaires to pay less tax than many middle-income workers. This isn't just a story about the rich. It's a story about how wealth is distributed globally and who ultimately shoulders the burden of taxation. But let's look ahead. What could happen if we closed loopholes, taxed wealth more equitably, or simplified the system? Would it create more opportunity for the middle class? Or would it discourage the innovation and investment that drive the global economy? These are the questions we need to ask as we chart the course for the future. Here's a thought for you to carry forward. The tax code may be written in legalese, but its real impact is on our lives, our communities, and our opportunities. If we understand the system, we can demand better, not just for ourselves, but for everyone. Thanks for being part of Economy Explorer. If you enjoyed this video, don't forget to like, comment, and subscribe. Keep the journey going. Check out the suggested videos for more insights into the global economy. Let's explore together.